Why do Bitcoin crashes feel inevitable, even when the charts look stable? Who's really losing billions when the market tumbles? And who's quietly profiting? And if leverage is this dangerous, how close are we to a wipeout that shakes the entire crypto system? Joe Carlasare says these swings aren't random. They're engineered by extreme leverage and forced liquidations. When Bitcoin drops, it's not casual traders selling, it's billions of dollars being yanked out of positions that borrowed money they didn't even have. If you don't understand this, you're not investing, you're gambling. And in this game, the house is armed with billions, leverage, zero mercy, and the next crash could hit faster than you expect. Hello everyone, and welcome back to our channel. This podcast summary video is based on Joe Carlasare's recent appearance on 10x Money Talks. This was a deep dive into Bitcoin, market crashes, extreme leverage, forced liquidations, and the hidden forces moving billions behind the scenes, and so much more. The whole conversation is almost 1 hour long, but we listened to it all and organized the most important ideas into a clear, straightforward summary, so you get the key takeaways without having to listen to the full episode. If you get value from our summaries, please like the video, subscribe to the channel, and comment your thoughts below, because that really helps the channel and keeps this content coming your way. Joe begins by addressing a common question. Why does Bitcoin experience sudden, dramatic price swings? He emphasizes that it isn't everyday investors casually deciding to sell. Instead, the main driver is highly leveraged trading on exchanges like Bybit, Kraken, or Coinbase. Traders deposit Bitcoin they already own, say $100,000 worth, and borrow money to increase their positions, often 10x, 30x, or even 100x. In practical terms, this means someone putting in $100,000 of Bitcoin with 10x leverage is effectively controlling $1 million worth of Bitcoin. Small market fluctuations, as little as 2 to 3%, can trigger automatic liquidations, wiping out the trader's position. The exchange sells their Bitcoin to cover the loan, and the proceeds go to the opposing trader who is on the other side of the trade. This leverage creates a cascading effect on the market. When multiple traders are liquidated at once, their sell orders flood the market, causing rapid price declines. Conversely, if traders holding short positions are liquidated, they are forced to buy Bitcoin to cover, creating sudden upward spikes. Joe compares this system to gambling, highlighting that it's high stakes and risky, similar to zero-day stock options where traders bet on short-term price movements with borrowed money. The key insight is that Bitcoin's extreme volatility is often structural, not driven by fundamental news or investor sentiment. And this explains why prices can drop 10% in a single day or spike unexpectedly. Joe then shifts to the role of Bitcoin as a financial safeguard. Unlike traditional fiat currencies, Bitcoin is provably finite, with a capped total supply. This makes it a unique hedge against inflation, particularly when government spending rises. He explains that the purpose of investment is fundamentally to outpace inflation. While many investors today aim to generate passive income or revenue streams, the underlying principle remains: your money should at least preserve purchasing power. Joe argues that government debt, even if $37 trillion, is not inherently alarming when measured against the United States' overall economic growth and asset base. Debt becomes a problem only when it is unproductive or when interest costs exceed the economy's growth rate. Currently, the U.S. can borrow for 10 years at roughly 4%, while nominal GDP growth, combining real growth and inflation, is about 6.8%. This difference means the country can manage its debt sustainably. Joe stresses that individuals looking to protect their wealth against inflation and fiscal mismanagement can use Bitcoin as a form of insurance, alongside other assets like real estate, stocks, or even gold. Joe also provides a broader view of a U.S. financial system. While discussions about national debt can be alarming, it's essential to consider both liabilities and assets. The United States has $37 trillion in national debt, but its total assets, including government holdings, infrastructure, financial markets, and natural resources, are estimated at over $250 trillion. From a balance sheet perspective, this is a healthy position, similar to a profitable business with temporary liabilities. Joe points out that the debt-to-GDP ratio, often used in public debates, is a simplistic measure that doesn't fully reflect economic strength. For example, U.S. GDP has grown significantly over the past 5 years, adding roughly 2% of the global GDP, which is equivalent to the economic output of several mid-sized countries combined. Even with rising debt, the U.S. economy's growth and resources make its financial system resilient. Joe also compares this to other countries with weaker economies or limited financial systems, emphasizing that relative to the rest of the world, the U.S. remains exceptionally strong. The discussion then turns to the U.S. dollar's position and Treasury debt. While some fear a shift away from the dollar, Joe stresses that most global transactions and debts are still denominated in dollars. Approximately two-thirds of U.S. debt is held domestically, including by pensions, individuals, companies, and the Federal Reserve. Foreign holdings currently account for roughly a third of Treasury debt, which is manageable. For perspective, in the 1970s, less than 10% of U.S. debt was held by foreign entities. Even if foreign holdings decrease today, the levels would still be higher than historically, and the U.S. economy has grown substantially, making such shifts less concerning. Joe also clarifies that minor fluctuations in the dollar's exchange rate, such as changes against the euro or yen, are not particularly meaningful. What matters more is the overall dominance of the dollar in global trade and finance. Despite reports of some countries diversifying into gold or other assets, the dollar's status as the world's primary reserve currency remains secure. Joe concludes that, relative to other nations with weaker economies, military challenges, or financial instability, the U.S. remains the safest home for capital. When asked why central banks favor gold over Bitcoin, Joe explains that it's largely about structure and optics. Publicly acknowledging Bitcoin purchases could disrupt confidence in sovereign debt markets. Treasury debt is the core of the financial system, and central banks need to maintain its stability. While some speculate about China or other countries secretly acquiring Bitcoin, there is little verifiable data, and any purchases would likely be reflected in price movements rather than public disclosure. Joe predicts that adoption of Bitcoin by central banks and major financial institutions will happen gradually. For now, there are structural barriers, regulatory considerations, and risk management concerns. While Bitcoin has a strong future as an investment and hedge against inflation, it has yet to become a mainstream tool for sovereign institutions. This cautious approach preserves stability in global financial markets, even as Bitcoin gains recognition among individual and institutional investors. Finally, Joe shares his personal outlook for Bitcoin. He is bullish, projecting that Bitcoin will end the year above $130,000, with potential to reach $140,000. He explains that while long-term holders have been selling, new money is steadily entering the market, creating balance and support for the price. He expects Bitcoin to perform well next year as well, with broader financial markets also showing strength. Joe concludes with a message for younger investors. The financial landscape offers enormous opportunities, and optimism should guide strategy. Instead of fearing market volatility, investors can learn to navigate it, leverage opportunities, and grow their wealth. For Joe, Bitcoin represents not just a speculative asset, but a strategic tool to safeguard purchasing power, outpace inflation, and participate in a financial system that remains remarkably robust despite global uncertainties.